Another day, another story. In the world of finance, businesses continually seek innovative ways to optimize their financial structures and improve their financial performance. One such strategy is off-balance sheet financing. This method allows companies to keep certain assets, liabilities, or activities off their balance sheets, providing unique opportunities for financial flexibility and risk management. In this video, we will delve into the concept of off-balance sheet financing, explore its advantages and examples, and discuss its implications for businesses. Off-balance sheet financing refers to the practice of keeping certain financial items off a company's balance sheet, which is the financial statement that outlines a company's assets, liabilities, and shareholders' equity. While these items may not be directly recorded on the balance sheet, they still have financial implications and can impact a company's overall financial health and performance. Lease arrangements. Rather than purchasing assets outright, businesses can enter into lease agreements to access equipment, vehicles, or property. The leased assets are not recorded as owned on the balance sheet, and the related lease payments are treated as operating expenses rather than debt. Joint ventures and special purpose entities, SPES. Companies may form joint ventures or establish special purpose entities to undertake specific projects or investments. These entities are often structured in a way that allows the company to keep the associated assets, liabilities, and risks off its balance sheet, while still benefiting from the project's potential returns. Off-balance sheet debt. Some companies use off-balance sheet financing techniques to issue debt without explicitly recording it on their balance sheets. This can be done through instruments such as operating leases, where the future lease payments are not disclosed as debt, or through securitization, where loans are packaged and sold to investors, removing them from the balance sheet. Advantages of off-balance sheet financing. Improved financial ratios. By keeping certain assets and liabilities off the balance sheet, companies can enhance key financial ratios such as debt-to-equity ratio and return on assets. This can present a more favorable financial profile to investors, lenders, and other stakeholders, potentially lowering borrowing costs and improving the company's creditworthiness. Enhanced financial flexibility. Off-balance sheet financing allows companies to access resources and undertake projects without incurring significant debt or tying up substantial amounts of capital. Leasing, for example, enables businesses to utilize assets without the burden of ownership, preserving liquidity and flexibility for other strategic initiatives. Risk mitigation. Off-balance sheet financing can help manage and mitigate certain risks. By transferring assets or activities to separate entities or joint ventures, companies can isolate potential liabilities and protect their core business from associated risks. This strategy can shield the company from adverse outcomes and limit financial exposure. Examples of off-balance sheet financing. Operating leases. Companies often lease assets such as buildings, vehicles, or equipment instead of purchasing them. The lease payments are treated as operating expenses rather than debt, allowing the assets to be kept off the balance sheet. Joint ventures. Companies form joint ventures with other entities to undertake specific projects or enter new markets. By establishing a separate entity, companies can share the risks and rewards of the venture without recording the assets, liabilities, and activities on their balance sheets. Special purpose entities, SPES, are separate legal entities created to hold specific assets or undertake specific transactions. Companies use SPES to securitize assets, manage risks, or isolate potential liabilities, thereby keeping them off their balance sheets. Implications and considerations. While off-balance sheet financing offers certain advantages, it is crucial for businesses to carefully consider the implications and potential risks associated with this strategy. Transparency and reporting. Off-balance sheet financing can complicate financial reporting and analysis. It is important for companies to provide clear and transparent disclosures regarding their off-balance sheet arrangements to ensure that investors and stakeholders have a complete understanding of the company's financial position. Regulatory and accounting changes. Accounting standards and regulations, such as the International Financial Reporting Standards, IFRS, and Generally Accepted Accounting Principles, GAAP, continue to evolve. Changes in these standards may impact how off-balance sheet items are accounted for, potentially requiring adjustments and disclosures that can affect financial statements. Potential loss of control. While off-balance sheet financing can offer flexibility, it may also lead to a loss of control over certain assets or activities. Joint ventures and special purpose entities, for example, involve collaboration with external parties, which requires careful consideration of governance structures and decision-making processes. Hidden risks and contingencies. Although off-balance sheet financing can provide risk mitigation, it is important to recognize that these risks are not completely eliminated. Contingent liabilities and risks associated with off-balance sheet items can still have an impact on a company's financial health and reputation. Companies should conduct thorough risk assessments and ensure appropriate risk management practices are in place. Investor perception and creditworthiness. While certain off-balance sheet arrangements may improve financial ratios, investors and lenders may still consider the overall risk exposure and the potential impact on the company's creditworthiness. It is important for businesses to communicate and educate stakeholders about the rationale and implications of their off-balance sheet financing activities. Regulatory scrutiny and compliance. Off-balance sheet financing has received scrutiny from regulators due to its potential for abuse or manipulation. Companies must ensure compliance with applicable laws, regulations, and disclosure requirements to avoid any legal or reputational consequences. Off-balance sheet financing can be a valuable tool for businesses seeking financial flexibility, improved ratios, and risk management. Examples such as operating leases, joint ventures, and special purpose entities demonstrate the diverse applications of this strategy. However, it is essential for businesses to carefully consider the transparency, regulatory changes, control implications, hidden risks, and investor perception associated with off-balance sheet financing. By conducting thorough assessments and adopting robust risk management practices, businesses can navigate this strategy effectively and derive the maximum benefits while maintaining transparency and compliance. Thanks for watching.